Welcome back to Switzer on Australia's business channel. Well, the self-managed super fund sector is booming in Australia. Data from the Australian Tax Office's recent quarterly update reveals the number of Aussies that are members of self-managed super funds is now nearly 5% of the population. So with the May budget on the horizon, what should we be watching? Well, for more, I'm joined in the studio by Paul Rickard from the Switzer Super Report. Paul, thanks for your time tonight. Just want to start with some tax changes, and there's been a lot of speculation on further changes to really the tax treatment of superannuation. Can you fill us in and our viewers on what's the latest?
Well, we hope there won't be any changes, but it's one of those things. There has been a lot of speculation. It's got a little bit quiet as we go into the May budget, but I think we're all waiting to see what happens. So the changes were sort of in three areas. The first change was to look at the capital gains tax treatment. So when assets get transferred into super and you move into what's called the pension phase, they technically become free of capital gains tax. So a lot of people in self-managed superannuation funds were buying property and potentially looking for property to become inside super capital gains tax free. So that was one. The second, as people get older, is looking at the so-called transition to retirement pension, which happens when you can take when you turn 55, and looking at tightening on that up, and potentially also looking at the so-called preservation age, that age when you can first access your superannuation. And thirdly, was looking at whether the general rates of the tax on earnings inside superannuation of 15%, whether that should be higher. Basically, a whole lot of people in Treasury want to get a whole lot more money out of the super system.
What will be the implications of that if some of that happens?
Well, it's not going to be good for superannuants, and we hope that the government, at the end of the day, will see sense. And because people invest in super with really long-term time horizons, and nothing they hate more than seeing the system change all the time.
Right, and taxing their money.
And taxing their money. So, look, we hope the government will actually see sense in an election year, saying sanity will prevail, but at the moment there certainly is fear that come May there'll be some further changes.
And with the super moving from 9 to 12% in contributions, and this being a compulsory move, isn't that an interesting move then to tax, if they change the tax implications of this, if they're forcing people to put more money into
Absolutely.
super?
So it goes up to 9.25% from the 1st of July.
Right.
And the cap on that amount of money, the total amount that your employer or that you can put in through salary sacrifice, is still only $25,000. Now, as that goes up to 12%, that ain't going to cover a lot of people.
Yeah.
So it is, on the one hand, they're saying, oh, put more money into super. On the other hand, they're saying, well, let's think about how we tax it more efficiently.
Yeah.
So I think the government needs to have take a big, deep shower, and we all need collectively to sort of keep the pressure on. So I'm hoping that, as I said, sanity will prevail. Look, if you are worried about it, there are always the things you should do leading into any sort of change. One is to make sure that you're optimising your caps. At the moment, you have two caps for superannuation. One is the so-called concessional contributions. That's the sort of the compulsory 9%, and or any salary sacrifice, and or any amount that you do as you claim a tax deduction for. That's $25,000. So make sure that you're contributing up to the maximum of $25,000 if you can. Don't go over. And then the other cap is what we call the non-concessional contributions cap, and that's your own money. And potentially you can put $150,000 in that in any year. If you're under 65, you can do 3 years' worth in one go, $450,000. So if you're worried about any of these changes, then the advice would be make sure you're on track ahead of this financial year before any changes potentially in the May budget.
Now, of course, these are all potentials, but do you expect any changes in the May budget? I mean, what is the consensus?
I think the consensus is a lot of the things around capital gains tax and looking at transition to retirement pensions is basically too hard. That is that the government might change them, but they'd have no impact on next year's revenue. So the easiest change to do would be to increase the tax rate on earnings. It's currently 15%. I think if there's a risk, it is that they'll increase the tax rate from about 15% to 17%.
All right.
But at the moment, I'm hoping that because of the outcry, and you've seen people like Bill Kelty and Paul Keating and others saying, leave the system alone, sanity will prevail.
Reform seems to be the topic of the moment, though, I've got to tell you. But
well, not necessarily more tax reform, Ingrid.
All right, let's talk a bit about self-managed super funds and investing in these and asset allocation decisions. Is yield still the flavour of the day? I mean, it is in equity markets. It's
still very much the flavour of the day, and most of the rally we've had in the last 4 or 5 months has been into the so-called yield stocks. The banks, the consumer staples, the Telstras, those sort of sectors. If you've been listening to the Switzer Super Report, we told you last June you had to get into the market. It's really taken off the last few months, but we've had a good pullback today. My sense is that over the medium term, people will start to see the yield as not being as attractive. There's some good talk that maybe the banks have run a bit too far. Certainly some of the consumer staples and things like Woolworths and Wesfarmers have got very, very expensive very quickly.
Yep.
But at the moment, a lot of trustees who were a little bit concerned, have been in cash and term deposits, are looking at the return on term deposits and saying that's not very attractive. And bank dividend yields at over 5% still look relatively attractive.
Yeah, and there seems to be a lot of people moving into shares.
Yeah, and I think that's going to continue. So, you know, this whole thing with Cyprus, is this the start of a small correction, a big correction, the end of the world? I don't think it's the end of the world. Maybe it's the start of the correction people are hoping for. And although we've only had 2% today, if you get a 3 or 4% pullback, this might be the time. I mean, I think the biggest risk at the moment is not to be in the market.
Yeah.
People talk a lot about risk, and they talk about a lot of risk of capital loss, but you've also got to think superannuation's got to last for a long time.
Yeah.
And if all your money's in cash and term deposits, I'd be really worried.
Yeah.
So I'd be starting to think about how you get a little more exposure to
So
some
would you
growth
be
assets.
in all? Would you be diversifying then?
Well, I always believe in diversification, so I think that's a fundamental rule, have across all the asset classes. I think that what we're seeing is that the equities market looks attractive, so it's a matter of finding the opportunity to get into the market. We're getting a lot of good data out of the property market. I mean, if you think about what the central banks are trying to do out there, they're trying to get asset price inflation. They've been pumping all this money in Japan and the US and Europe. What they want to do is finally get his asset prices to move up, and that's starting to happen. And so you're getting good growth in the equities market. You're starting to see some good signs in the property market here locally. Some, auction clearance rates in Sydney have been over 70% 4 weekends in a row.
Yep.
The Melbourne rate's also been pretty strong. A big weekend coming up. I think this next weekend's the biggest weekend of the year or something.
Yep. Super Saturday.
Super Saturday, they call it. And you've got lots of other experts on property. But you are seeing, those sort of markets.
Yep.
You're starting to see some good price appreciation occur.
Any other sectors besides property that are seeing interest?
Well, the one I'm worried about is the fixed income market, the bond market.
Okay.
Because what tends to happen, that's why we talk about diversification, is that not all asset classes go in the same direction. And we talk about negative correlation. So what is starting to happen is, as we're getting a bit more globally, people are starting to take a bit more risk, is good appreciation in the share market, some interest in property, but bond yields are also starting to rise. And when bond yields rise, bond prices fall. So in Australia, the 10-year bond rate has moved up from 2.7% to almost 3.6%. In the US, it's up from 1.4%. This is the 10-year US government bond yield to around 2%. So the bond market's almost gone into a bit of a bear market. And I think if you've got long-term bonds and other things, you've got to think about shorting a little bit. Maybe it's a good time to be borrowing out there. So, interest rates have come down so low, this is the time to actually borrow on a long-term basis.
Can I ask you, we said in our intro there that, the self-managed super fund sector is booming. Can you talk us through why?
Well, I think there are two reasons. One is it offers access to so many other asset classes. So if you want to have direct property in your superannuation fund, you can do so. If you want to put a business property, you can do so. It's very hard to do that through a retailer or industry fund. So that's the first reason. And you can take that extension with things like artwork and commodities, and people who know what they're doing are interested in those other types of perhaps slightly more exotic assets. And I think secondly is just relative cost performance. There's perception, rightly or wrongly, that a lot of the so-called professional managers haven't done so well, charge high fees. So why pay a professional to manage money? Now, there are good arguments why you should, and sometimes there are arguments why you shouldn't, but a lot of people think that they can do that better. And then probably the third reason, and this is what's really important, is people feel through things like franked dividends and the timing of when you start pensions, you can really drive the tax outcomes more effectively in a fund that you control rather than having someone else control that for you. And at the end of the day, it's what you get after tax that matters. And I think that's really a key driver as well.
All right, Paul, thanks for your time tonight.
Thanks, Ingrid. Good to see you.
Paul Rickard there. Well, after the break, we'll find out why small business optimism is on the rise with Gary Green from Bibby Financial Services. Back in a moment.